A lot of the money that our banks on lend into the mortgage market is money that's sourced in the US. And so, again, with a weaker Australian dollar, you're buying another commodity, being US dollars, to lend out. You're paying more for it. Now, banks tend to hedge out their currency risk, so the net impact on the borrower in Australia is not that marked, but nonetheless, there's a higher cost of sourcing those funds too. So what you end up with is a series of higher import costs, which are inflationary. On the other side of the coin, for our companies that are exporters, so if we think about a resources sector, resources globally are priced in US dollars. So if you mine something in Australia, sell it in US dollars, when you repatriate that money, you're actually bringing back relatively more, because you're selling your commodity in US and then you're translating it back to Aussie. So for our miners, it could be a positive. Hey guys, welcome to this week's Money Investing Show. The Aussie dollar, the currency we all get to spend each and every day. We're going to take a look at its relative weakness right now, why that might be, and where our outlook sits over the next 3 to 6 months. Plenty to take out of this, particularly as you start to realise the impact it's likely to have, not just on the Australian economy, but on everyday Australians. Hey guys, welcome to this week's Money Investing Show with me, your host, Andrew Baxter, and as always, my offsider and co-host, Mitchell Laurential.
Thank you, Mr. B. Good to be here. A bit of a technical podcast today, but a really relevant one, and that's the future of the Australian dollar. So whether you're an everyday Australian, an importer, an exporter, or someone with a portfolio of shares or investments, this episode is for you.
Most definitely, it's our currency, the Aussie. It is what it is, and I think it's on the wrong end of a hiding, and that's something we're likely to see continue over the foreseeable.
Indeed, and we've seen, for example, say pegged to the US dollar, the Australian dollar has been quite weak. So at the time of this recording, about 61 cents in the dollar relative to the US, which has been extremely strong, the US dollar.
It's interesting. I mean, in the US, we've started a cycle of interest rate cuts. We've seen 3 cuts already in that cycle. We haven't seen one here in Australia. And normally, under normal economic circumstances, let's use the term ceteris paribus, which is the Latin, assuming all things remain equal.
Right.
If you've got interest rate cuts in the US and not Australia, you'd expect to see the Aussie dollar actually firming against the US, but we've seen the opposite. And I think part of the reason for that is the outlook towards the Australian economy is pretty gloomy. I mean, we talked to this fairly recently in our expectations for the year. And a weaker economy typically is associated with a weaker currency. And I think, if we move into a rate cutting chapter for Australia, which I suspect we'll start to see as this year progresses, that weakness is likely to continue.
So question to you then, in a little bit more depth, how does the US have such a major impact on us? In particular, if we look at interest rates. As you say, US have cut interest rates. Does that mean more people are spending?
So obviously, this year being an election year as well, you can expect to see some generosity, I think, from the government there too, which in itself could potentially be inflationary and slow interest rate cuts down.
So you mentioned economic outlook and economic strength affecting the dollar. So I mean, our dollar quite weak at the moment. Is that kind of a leading indicator for our economy not being as strong in 2025?
Yeah, I think that's got to be seen as that, particularly if it is accompanied at some point with rate cuts. But it doesn't have to just be a bad thing. There are some negative factors with having a weaker currency, which the first one is our imports into Australia become more expensive, because if you're having to buy them with a weaker currency, relatively speaking, they're more expensive. You run the risk of having what's called imported inflation. And a very good example of that would be oil and energy costs, because oil is priced in US dollars. And as Australian consumers, you're needing more and more Aussie dollars to be able to buy the same quantity of oil if it's priced in US dollars. As a consequence, oil prices move higher, becomes inflationary.
Oof, that's tough. So the importer struggles and then has to pass that on to the consumers. Everyday Australians like us pay more at the bowser.
Your raw material costs effectively are going up, which is tricky, and that's assuming oil prices don't move up. With the incumbent President 47 in the US, there's an expectation that commodity prices, particularly oil, is likely to move lower, but that is a risk for Aussies. Even if we see a fall, if you will, in energy prices in a US dollar basis, that may not translate into the same for Aussie dollars. And of course, that then translates onto things like flying. So, we've all enjoyed a good period of travel in the post-pandemic environment, yet airfares haven't particularly come down due to competition and other factors like that. But also, if we see a continued weakness of the Australian dollar, such a large component of air travel is the cost of fuel, which is priced in US dollars. Expect to see higher airfares.
Interesting. Okay, so let's take this a level deeper then. What about with banks when it comes to borrowing and lending money?
Yeah, for our banks, a lot of the money that our banks on lend into the mortgage market is money that's sourced in the US. And so, again, with a weaker Australian dollar, you're buying another commodity, being US dollars, to lend out. You're paying more for it. Now, banks tend to hedge out their currency risk, so the net impact on the borrower in Australia is not that marked, but nonetheless, there's a higher cost of sourcing those funds too. So what you end up with is a series of higher import costs, which are inflationary. On the other side of the coin, for our companies that are exporters, so if we think about a resources sector, resources globally are priced in US dollars. So if you mine something in Australia, sell it in US dollars, when you repatriate that money, you're actually bringing back relatively more, because you're selling your commodity in US and then you're translating it back to Aussie. So for our miners, it could be a positive.
Okay, so a weaker Aussie dollar is not necessarily the worst thing for companies like Fortescue and BHP.
No, it can be quite good for earnings.
Which effectively is about 1/3 of our entire stock market is resource stocks. So
that's right, but again, that's also governed on what commodity prices are actually doing, and we've seen a level of weakness there. So, if you didn't see any movement in commodity prices from where they are now, but we saw a continued weakness of the dollar, then net it would be a benefit.
Ceteris paribus, is that what it's called?
The best assumption in the world.
Okay, anything else with exporters that is resulting from a lower Aussie dollar?
Yeah, I mean, we do have a bit of an advantage, like across the board. Your exports relatively become cheaper. So, for example, our wine industry, if you're exporting into US dollar denominated markets, then that can be a positive. So generally speaking, for exporters, it's more of a positive. For importers, it's a disaster. And if you look at our terms of trade and balance of payments, if you exclude major bulk commodities like coal and iron ore, we run a massive trade deficit. In other words, we import far more than we export. So generally, that would skew things in my mind towards the negative impact of a weaker dollar rather than positive.
Okay. Anything else for the everyday Australian? We've spoken about fuel prices, raw materials. Anything else that springs to mind, AB?
Look, it's challenging. I mean, travel is a big one. Going overseas, the rite of passage, whether that's the ski trip over the winter and Christmas, or whether it's Europe in the summer.
You're off this year again, I take it.
Well, big news in the Baxter household. There's another baby on its way through. So that might
slow you down.
Yeah, number 6.
That's okay.
There's inflation for you.
Yeah, I can take that villa away from you over there if you need it in that case.
So that might curtail things mid-year, but probably later in the year. Might get off skiing out in Switzerland or something at the end of the year. But we'll see how we go with the little one. So travel's probably a good example of one that tends to affect people. And look, these sound like first world problems, but there are knock-on effects of this. If you think about companies like Flight Centre, for example, that rely on people travelling overseas for their substantial income, it runs a risk of denigrating earnings. So, overall, it's not a positive thing. You like to see stable currencies, and if you put the boot on the other foot, you go back to the sort of the mid 2000s, and we had a level of parity just after the GFC. And in fact, beyond parity, where you go to the US and it was 107 to the US dollar. So that
Crazy.
was a brilliant time to be going there. You look at it where it sits right now, and it's almost half that. In other words, it's twice the cost of going to the US. And I've been over there in the past when, you're buying a $6 coffee, which is $12 Aussie. And
it's nuts, isn't it?
And so there's a very, very marked impact there. But I think the outlook on our economy and what the currency move actually says is more of a concern, because what it shows you is that globally the momentum, if you will, within our economy isn't perceived as being that strong, and it is a pretty good early indicator. As they say in most of the movies, follow the money trail, and if the money trail is not buying Aussie dollars to invest in Australia, there's a reason for that, and that's because it's not perceived as an attractive market.
So speaking of markets then and investment opportunities, like I speak personally for myself on the trading desk, a lot of our clients are heavily invested in US stocks and US equities. So if they've got US cash, or when they sell the proceeds of those shares, they sit in US dollars, it's been really, really good. Then poses the risk of the US dollar not being as strong in the future. So how do you hedge that out?
Yeah, look, good point. And currency gains are a big part when you have overseas investing, and it's been good for a lot of our clients, as you say, given the skew we've got toward that US market. there are several things you can do. I mean, I usually typically hold my funds in USD after I close out of a trade anyway, because I'm just putting more money into that currency. But you can hedge out. You can buy currency options, for example, that give you the ability to lock in an exchange rate over a period of time. And look, we've done this in the past for sort of, I guess, higher net worth clients that are putting quite a substantial chunk of money into that market, and being able to protect that exchange rate is quite key. There's no discrimination in that statement either. It's just the fact that it costs money to hedge. So if you're working with a fairly small amount and then factor in a hedging cost, it doesn't become cost effective. But certainly when you're working with larger amounts, it most certainly does.
There are ETFs out there too. We've recently discovered, probably in the last 12 months or so, where we had this exact problem. We had high net worth clients heavily invested in the US. How are we going to hedge out that risk? So you can be long or short a particular ETF, and there's also short and long ETFs depending on what currency you want to trade. Even just a small exposure to that may be able to offset any of that, not any, but a fair bit of that risk.
Yeah, they're all steps that you can take, and each layer of that gives you, I guess, it's another layer of complexity, it's another layer of potential cost, and there's another layer of potentially erroneous analytics. But at the same time, the key to what we do is trying to box in risk as much as we can. And so, currency risk is a very real one for people. And so taking that one quite seriously is key. If we see a little bit more of a push on, you don't have to hedge your whole portfolio. You could partially hedge it, so you're locking in some currency gains and leaving the rest to swing in the breeze.
That's right. And if you're a Forex trader out there, which means you're actually trading the currency itself, you could be playing that either which way that you see fit, right?
Currency trading, certainly, these are boon times if you've got a definitive view on what's going on. And more than anything, Mitch, I just think it comes back down to, outlook and what's driving things. And, we're in a stagnant position as an economy right now. As we've alluded to, our biggest trading partner's in trouble economically, and that will rub off on us. On the other side of the coin, particularly as we're comparing the Aussie to the US for the benefit of this interview, the US is in a situation where you've got a new government that's fairly committed to regenerating America on every stage, whether that be being a corporate champion of the world and within its domestic economy, reinvesting in there is likely to be an economy that really roars over the next few years. And a strong economy equates typically to a stronger currency. And that differential I don't see coming in anytime soon. I think it's likely to blow out a little bit further.
So future of the Aussie dollar, we can say, at least in the short term for us, may not be necessarily as strong.
That's right. There'll be other countries around the world that it will firm up against, whether that's sterling, whether that be the euro, but certainly against the US, which is the predominant view that we carry because our investment is largely in the US, then, I think that will be my expectation for the next few months for sure.
Interesting. Thank you very much for our listeners out there, AB.
My pleasure. Anytime, Mitch. There you have it, guys. Make sure you like, comment, subscribe. Most importantly, hit the notification button, and we'll look forward to hosting you next week.